Welcome back to The Deep Dive. It is Tuesday, February 10th, 2026. And today, we are doing something a little different. Usually, we look at tech startups or, emerging trends, but today we are looking at a company that is honestly less of a business and more of a global economic bellwether.
We are talking, of course, about Coca-Cola.
Yes.
It's the ultimate thermometer for the global consumer economy.
Exactly. Because let's be real, if people in Mumbai or Munich or Minneapolis stop buying a Coke, something is usually wrong with the bigger picture.
For sure.
And today is a massive day for them. They just released their Q4 and full year 2025 earnings report. And let me tell you, digging through the stack of sources, we've got the press release, the full transcript from the earnings call.
With outgoing CEO James Quincy and the new boss, Enrique Braun.
Right, and the slide decks. It is a fascinating moment.
It really is. I mean, it's not just business as usual. We have a rare revenue miss, some solid profit beats, and a massive changing of the guard at the very top.
Right. And our mission today is to unpack exactly how a company with $32 billion brands navigates what they're calling a complex external environment. We're going to get into the numbers, including a billion-dollar write-down on a sports drink that might surprise you. We're going to talk about a haunted Fanta factory and a strategy called lift and shift.
It sounds like a workout routine, but it's actually their plan for global domination.
We'll get to that. But let's start with the scorecard. The headlines came out this morning. How did the beverage giant actually perform in Q4?
So it's a mixed bag, which honestly makes for a clearer picture of the economy than a straight win would.
Okay.
On the top line, revenue came in at $11.8 billion for the quarter. Now that is growth, it's up 2%, but here is the snag. Wall Street was expecting $12.04 billion.
Oh, wow. So they missed.
They missed expectations by over $200 million.
Which, for a machine as consistent and predictable as Coca-Cola, is notable. They don't usually miss the top line like that.
Exactly. It signals that things are tighter out there than analysts predicted.
Yeah.
But then you look at the bottom line, the earnings per share, or EPS.
And it's a different story.
A totally different story.
Yeah.
Comparable EPS was $1.58, which beat the consensus by 2 cents. And if you look at the full year, they grew organic revenues by 5%.
So the engine is still running, but maybe with some warning lights on the dashboard.
That's a great way to put it.
Okay, let's unpack one of those warning lights immediately because this number jumped off the page at me. Reported operating income for the quarter plunged 32%. I mean, that sounds catastrophic. Did people just stop drinking soda for 3 months?
No, the liquid is still flowing. That 32% drop isn't an operational collapse. It's an accounting reality check.
Okay.
It's almost entirely due to a non-cash impairment charge of $960 million.
$960 million.
Yep, related to the body armor trademark.
Whoa. Nearly $1 billion. I think we need to pause and explain impairment charge for a second because that sounds like legal jargon for we lost a lot of money.
It's essentially a revaluation. Think of it this way. Imagine you bought a classic car 5 years ago for $100,000 because you thought it was going to double in value.
Okay.
Today, you look at the market and you realize nobody's buying that model anymore, and it's really only worth, say, $80,000. You haven't lost the cash today. You spent that years ago, but you have to admit on your balance sheet that your asset is worth way less than you thought.
So Coke had to admit that body armor, which they bought to take down Gatorade,
The acquisition.
is worth $1 billion less than they expected.
Precisely. And on the call, they were pretty transparent about the why.
Yeah.
They revised their projections. The sports drink category growth has just slowed down significantly.
And the shelf got crowded.
Very crowded. I mean, think of Prime, Gatorade, all these new entrants. So essentially, they're admitting, we thought this asset was a rocket ship, but it's actually just a very nice car.
It's a humbling moment in an otherwise strong report. But let's look at where the money is actually coming from. I noticed a trend in the data, something we've seen for a while now. The battle between price and volume.
This is the key to understanding the current consumer landscape. For the full year 2025, Coca-Cola saw 4% growth in price mix.
So they're charging more or selling more of the premium packages.
Right, like those little mini cans.
Right.
But unit case volume, flat, even, 0% growth.
So to put it plainly, they aren't selling more liquid.
Nope.
They're just getting more money for the liquid they do sell.
Exactly. And that works for a while. It protects the margins. But it also signals that there is a ceiling. You can't just keep raising prices forever if people aren't buying more stuff. It suggests that future growth has to come from somewhere else.
Which brings us to the people who have to solve that volume problem. This earnings call was officially the last one for James Quincy as CEO.
It's the end of an era. Quincy is moving to executive chair, and Enrique Braun is taking the reins as CEO. And honestly, for such a huge company, the transition is remarkably boring.
Boring in a good way.
Boring in the highest possible compliment sort of way.
Boring is good when you have billions at stake, right? You don't want a succession-style drama.
Absolutely. There's no knife fighting here. Both of these guys started at Coca-Cola in the same year over 30 years ago. They are lifers. They know the system inside and out.
And looking at Quincy's legacy, despite that body armor hit, he's leaving on a high note. The stats he rattled off. The company now has $32 billion brands.
And that number was much smaller when he took over in 2017. He really streamlined the portfolio. Remember, he was the one who killed off hundreds of zombie brands.
Right, those weird little sodas.
Kind of focus on the winners. And the market rewarded him. He's created over $150 billion in market value during his tenure.
So he cleaned house. Now, let's talk about the new guy. Enrique Braun. He was the chief operating officer. What's his vibe? Is he just Quincy 2.0?
There's a lot of continuity, but Braun has a slightly different flavor. He's extremely passionate about the franchise operating model. That's the relationship with the independent bottlers.
He's an operations guy.
Deeply. But what stood out to me was his sentiment on the call. He said, future success is never guaranteed, and that the company must remain discontented.
Discontented. I like that. It's like, we made $12 billion, but I'm still annoyed about it.
It's a healthy paranoia.
Yeah.
He's saying they need to get better every day. He's not coming in to just steer the ship. He wants to tighten the bolts and find new fuel.
Right.
He specifically mentioned they need to be constructively discontented.
Well, let's look at the map he's inheriting, because if he's discontented, it's probably because the map looks a little messy. They talk a lot about this all-weather strategy, basically using strong markets to cover for the weak ones so the global number always looks good. So where is the sun shining right now?
This was the biggest surprise for me. North America.
Really?
It is the absolute star of the show.
Because all we hear about is the U.S. consumer being tapped out inflation debt.
And yet they are buying Coke. Despite all that pressure on lower-income consumers, North America delivered strong results. I saw the operating margin figure nearly 30% for the full year.
For North America?
For North America. That is wild for a food and beverage company.
That is incredibly high. What's driving that?
It's a mix of pricing power and what they call premiumization. Brands like Trademark Coca-Cola, Sprite Zero, and Fairlife, which is their value-added dairy brand, all grew volume here. People might be skipping big purchases, but, you know, a Fairlife milk or a Sprite Zero feels like a affordable luxury.
Right. But it's not sunny everywhere. Quincy used a metaphor back in December that he referenced again on this call. He called the economic environment a light drizzle.
Right. It's not a storm. It's not a recessionary hurricane. It's just damp. It's persistent pressure.
And you see that drizzle turning into actual rain in places like China and India.
You do. They mention softness in consumer spending in both. And that's significant because isn't India supposed to be the massive growth engine for volume?
It is, and that's why it hurts. India is usually a volume driver. When that slows down due to weather or consumer confidence, it drags down the global volume number.
And looking ahead to 2026, there is a specific storm cloud brewing in Mexico.
Oh, right. The tax.
Mexico is facing a new excise tax, and Mexico is a huge market for them, one of the highest per capita consumption rates in the world. A tax there makes the product more expensive on the shelf.
Which usually hurts volume.
Right. But the expert insight here is fascinating because they aren't just accepting defeat. Braun has a plan to fight the tax with soccer.
Pretty much. Mexico is hosting the 2026 World Cup. So Braun's plan is to use revenue growth management, which is fancy corporate speak for adjusting pack sizes and prices.
So people can still afford a Coke.
Right, and combine that with the massive emotional hype of the World Cup. It's like, sorry the Coke costs more, but look, we're hosting the World Cup.
Exactly. They're betting the excitement will offset the tax pain. It's the all-weather strategy in action.
So we've got the scorecard and the map. Now let's talk about how they plan to grow. Braun was pretty blunt on the call about innovation. He admitted that innovation today is not where it needs to be.
That was refreshing honesty. Usually CEOs say, our pipeline is robust. Braun is saying, no, they are too slow. And his solution is something they call lift and shift.
Lift and shift. It sounds like something you hire movers for.
In a way, it is moving ideas. The old way was trying to invent a brand new beverage from scratch in a lab in Atlanta and push it to the world.
Uh,
Lift and shift means finding something that is working incredibly well in one local market, say Mexico, and lifting it and shifting it to other markets globally immediately.
and they gave a concrete example of this, Santa Clara.
Yes, Santa Clara is a dairy brand in Mexico. It started local, they nurtured it, and it just joined the billion-dollar brand club.
Mm.
So the strategy is don't reinvent the wheel. If premium dairy works in Mexico, can we replicate that success in similar markets? Innocent, the juice and smoothie brand, also hit billion-dollar status.
So it's efficient innovation. Instead of guessing, you bet on what's already winning somewhere else.
Exactly.
But they are also doing some fun stuff on the marketing side to get the younger generation. I have to ask about the Haunted Fanta Factory.
This is a great example of connecting with that younger demographic Braun is obsessed with. Fanta's a fun brand, but for Halloween, they didn't just put pumpkins on the can. They created immersive experiences in 50 markets. A haunted Fanta factory.
Like a physical haunted house.
Yes, experiential marketing. They realize that Gen Z wants experiences, not just commercials.
And they're going after college kids too, right?
The Rings of Magic campaign. They targeted 1,500 universities. This isn't just a billboard. It's being on campus doing study break activations. They're trying to recruit the next generation of loyalists before they get hooked on energy drinks or flavored water.
And speaking of getting hooked, they are pushing hard on sports drinks again, despite the body armor write-down.
They have to. They mentioned the FIFA World Cup qualifiers and MLS playoffs to push Powerade sours and Power Water. They can't cede that ground to Gatorade just because Body Armor hit a bump.
Okay, shifting gears to technology. You don't usually think of a 130-year-old soda company as a tech leader, but they announced a new role, a chief digital officer, and they gave a specific example of how they're using AI in India that I found pretty mind-blowing.
Coke Buddy.
Coke Buddy. It sounds cute, but the tech behind it is serious.
It is heavy lifting. So this is a B2B platform. It connects the bottlers directly to the store owners, the mom and pop shops. But it's not just an ordering app.
What else does it do?
It uses AI and generative AI to analyze data and suggest the next best SKU for that specific shopkeeper.
Wait, so the AI tells the shopkeeper, hey, based on what you're selling and what's happening in your neighborhood, you really need to stock more Sprite Zero right now.
Exactly.
Yeah.
It's using predictive analytics to drive sales at the granular street corner level. That is how you squeeze growth out of a market like India when consumer spending is soft.
That is fascinating. It's digitizing the old school distribution network.
And that's a key part of Braun's strategy. Digitizing the enterprise isn't just about consumer apps. It's about the plumbing of the business.
So bringing it all home, what is the outlook for 2026? They gave us guidance. What should we expect?
They are projecting organic revenue growth of 4% to 5%. That's solid. And for comparable EPS, they're looking at 7% to 8% growth, up from the $3 per share they hit in 2025.
And cash.
A lot of it. They're aiming for $12.2 billion in free cash flow. That is a massive war chest for dividends, reinvestment, or maybe another acquisition down the road.
And there was a surprise in the currency column. Usually on these calls, we hear about currency headwinds eating up profits because the dollar's too strong.
Not this time. This is a rare gift. For the first time in ages, currency is expected to be a tailwind. The dollar has weakened against some key currencies, particularly in Latin America, so that's actually going to help the reported numbers.
But it's not all smooth sailing. They are selling off some businesses, which changes the math a bit.
Right. They are divesting the bottling operations in Africa and a business called Che in Nigeria. That creates a revenue headwind of about 4% because those sales disappear from the books.
But strategically, it aligns with their goal of being asset light.
Exactly. Coke wants to be the brain and the brand, not necessarily the heavy lifter. Let the bottlers own the trucks and the factories.
And one weird little detail for the calendar nerds out there.
The calendar shift. Q1 2026 has 6 extra days compared to the prior year. That's going to make Q1 look artificially huge.
Oh, right.
But Q4 will have 6 fewer days. So if you're tracking this quarter by quarter, don't freak out if Q4 looks light next year. It's just the calendar playing tricks.
Good to know. Don't pop the champagne in Q1 just yet.
Exactly. Wait for the full year.
So let's wrap this up. We have a massive machine Coca-Cola that is pivoting leadership seamlessly. They are churning out over $12 billion in cash. They are dealing with a light drizzle economy by leaning into digital tech like AI for shopkeepers and trying to fix their innovation pipeline with lift and shift.
It's a story of resilience. They took $1 billion hit on body armor and just shrugged it off. They have soft markets in China and India, but North America and Latin America carry the load. It's the definition of a diversified portfolio.
But here's the provocative thought I want to leave you with. Based on Enrique Braun's comment about being discontented, we live in a world where trends move instantly. A YouTuber can launch a beverage brand like Prime and take massive market share in 6 months.
It's true. The speed of culture is faster than the speed of a corporation.
Exactly. So the question is, can a company of this size, with its massive bottling system and global supply chain, actually move fast enough to capture the next Bodyarmor before they have to buy it for billions? Or are they destined to always be the buyer, paying a premium for someone else's innovation?
That is the multi-billion-dollar question. Can they innovate from the inside, or are they just a bank that buys the winners? Braun seems to think they can. We'll see if lift and shift is the answer.
We certainly will. Thanks for diving deep with us into the world of red cans and balance sheets. Stay curious, and we'll catch you on the next one.